Well, today is December the 6th, 2019. Prior to the opening of the market in the early morning, it's 4:35 in the morning right now. What I thought I would show is yesterday's trading before today's market opens. And I guess, like a lot of traders, my sleep patterns aren't that great, so I'm doing nothing else in the morning, so I thought I would just demonstrate how today's or yesterday's market went, which was particularly good trading and a good example of the principles that I use for my method, which is I'm trading the NASDAQ E-mini futures, which are really good day trading vehicle. They're called E-minis, but they produce, as you will see, a large amount of profit for very small movement because they're highly leveraged. For a margin, a contract that has a day margin of $500, you get a lot of bang for the buck. You're controlling over $100,000 contract, and those rates apply to the day trading hours, which is the incentive for a lot of traders being day traders, because they get great margin rates. As usual, I have my bracket trading set up for the buy bracket. On the buy side of the market has the target set at a 5-point limit and the sell stops set at 5 points. Because we're getting into a little bit more volatility here, I usually like to set the kind of the default target and stop loss orders at 5 points. Same thing for the sell side of the trade, the sell bracket. I have the buy stops, which are the stop loss orders on the sell side, set to 5 points, and the target, the buy limit order, is set to 5 points on the sell side. So each side of the trade is set to 5-point brackets. And usually I can set the target, I can change the target of the volatility lowers to, I don't like to go normally lower than 2 points for targets. That's in really low volatility markets. In the higher volatility markets, I'll use a 5-point target, and also I'll drop the target as it becomes, as it looks like it's a good opportunity for a trailing stop loss type trade, and I'll show how that's done in today's example here. So that's how I set up my bracket. And just a brief review, sorry about that, just a brief review of the trade model here. As you know, the trades, the way the market moves is it tends to move in these swings. There will be an action swing, which is the long swing in the trend direction. In this case, this model would be showing an uptrend, and you'll have an action swing, then you'll have a reaction swing, and so it'll create these lightning bolt stair-stepping type patterns. And these are the formations that allow us to create a profitable or predictable entry point into the trade. So it'll create a number 1 point, number 2 point, which I usually call the hooks, and then a number 3 point. I'll usually call that the P3 point, P just standing for point, to differentiate it between a minor points and intermediate points, which I get into in other videos, but it's too much to get into here, so I'll just say P3 point is what I call the minor pivot points that create the minor swings. So at the beginning of each swing, you'll have each trend, you'll have a 1, 2, 3 bottom formation, and then you'll have a 1, 2, 3 top formation at the top of the trend. And in between, I distinguish the 1, 2, 3 points that occur in the trend. I've labeled them H for hook. Joe Ross calls them the Ross hooks, but generically I like to refer to them as hooks. Joe Ross is a great trader who I've got a lot of ideas from. If you ever pick up his book, a little bit more expensive, but it's good reading. What I like to do on the breakouts of these trend change formations, which are the 1, 2, 3 bottoms and 1, 2, 3 tops, I like to trade the breakouts of the number 2 point. But during the trend, I like to trade as the trend resumes 25% back into the direction of the trend as the previous swing. So if we took the distance from the previous swing and took 25% of that, that's where I want to enter the new swing, 25% away from the P3 point. So if this is the number 3 point, I want to enter about 25% into the new direction here. And I show the types of trend changes you can get. You can get type A, which the trend change formation occurs before the crossover signals of the indicators that I'm using. I'm using the 8 exponential moving average and the 14 simple moving average as crossover signals. And sometimes you'll get the 1, 2, 3 top or bottom occurring before the crossover is made. Sometimes they occur after the crossover is made, and sometimes they occur during the crossover is made. And on the type A, I like to trade the breakout of the number 2 point of the 1, 2, 3 top or bottom pattern that occurs simultaneously with the ADMA crossover. Type B, sometimes you won't get the trend change formation first, and you can trade as it crosses the 14 SMA line, and these are riskier type trades. If you want to take less risk, it's generally best to wait for the pullback to the ADMA line, then go trade in the direction you're trading. In this case, it's a short entry, but you'd reverse this for a long. You reverse all these. In all these cases, I'm showing short trade examples, but put a mirror up to it and trade in the reverse way if they were long entries into a uptrend. And the C type is, if it's concurrent with the crossover. This is why these trading at the 14 SMA line here is a little bit risky, because sometimes you'll get these 1, 2, 3 patterns that happen as the crossover is happening, and so it's best to trade as it comes back through after the number 3 point is made, as it comes back through the ADMA line. So these are the generally the 3 types of trend reversal patterns I'll usually see. The other type, it's not really a trend reversal, but if you notice in this case, the number 1 point is higher than the number 3 point. And if the situation were reversed and this is a 1, 2, 3 bottom, the number 1 point would be lower than the number 3 point. But sometimes you get a reverse hook situation where you'll just get a breakout below the number 2 point, even though the number 3 point might be higher in a 1, 2, 3 top formation. And I'll show a couple examples of these in the live trading. So I'll just explain what I'm kind of the reverse order. I've got everything mapped out here. I've already gone through the charts as I traded them for December the 5th. So I'll just show you where the ideal entry points would be on these charts, and then I'll do the actual trading from a recording of the recording software of this particular broker, which is a really great learning tool. I like to use it a lot. It's called Market Replay. And what I'm showing here is generally what the objective is. If it's in a trend, let's say in this case it's an uptrend, the price bars would be coming up would be moving upwards, and the ADMA line, this blue line here, would be expanding outward from the 14 SMA line. And so we create a angle here, like a alligator mouth opening. And so generally what you want to do is you want to wait for this number 3 point, or P3 point, and then trade as close as possible to the ADMA line. So that's the objective. In this case, I've shown my bracket orders here. So if I was long, my entry point would be here and would hit a target, which is the limit order, and that would take me out of profit. And the loss zone would be from my entry point to my stop loss order. And we want to stay out of this area if all possible, because that's the area that we're at risk. And as soon as we're out of risk, I'll bring up that stop loss and start locking in profit. In this case would be a long entry trade into an uptrend. Here's another type of pattern that can occur. You get a long pullback back to the ADMA, almost to the number 3 point here. A trade below the number 3 point would be a reversal. So we're looking for the new number 3 point, and you get a really long pullback. And it's very tempting to want to get into the trade before a P3 point is formed. But you just got to be patient and let that point form first. And then if you get back into the trade, it has to come back through the ADMA line in these long pullback situations, because these are usually foretelling a trend change pattern. So you got to be very careful with these. Make sure they definitely have momentum back into your intended trade direction before you try to take these trades. And they're a little bit riskier. You can also tell by the way the ADMA line is sloping. If that starts to slope inward towards the magenta colored 14 SMA line, that's a sign of a trend change. And I'll show a lot of examples of this. This is just how I've colored my indicators. I've colored my 8 EMA line blue, and my 14 SMA line, the simple moving average, magenta colored. Sometimes you'll get a situation where you're in a steeply trending market, and it won't make a proper number 3 point, but you'll get a number 2 point, which is higher than the previous high and higher than the high that follows in the case of an uptrend. And but you won't get a number 3 point. And so I call these inside bars. And the caveat is, if it's strongly trending, these will be good, usually good trade entry points, as long as you get it close to that ADMA line on your entry. So that's for really strongly trending markets, but I wouldn't try to trade these if the market's sideways and it's in a trading range type pattern. But I call these the phantom P3 points, or phantom number 3 points. And I'll show some examples of those if I can. Sorry about the fan noise from my computer. The microphone happens to be built in right next to the fan, but I don't actually hear it too much as I'm trading. But I've got a good fan on this computer to keep it cool, because it uses a lot of power here. This is how the market looked on the December 5th, yesterday, prior, or just as it opens. And here's the market prior to opening, which is flat and sideways. So this is the overnight market. And as you can see, the minute that U.S. market opened at 6:30 Pacific time, it just, moves up a little bit here prior to the market open, then slams right down through the support area. Normally I wait for the fractal formation, or that 1, 2, 3 formation, to form first before entering a trade, but a lot of times you can get really good trades on the breakout of support or resistance. Normally I don't like to trade the formations that occur in the overseas markets, because when the U.S. markets open, they're significantly different characteristic than the overnight markets, because the volume change just changes the character of the market. See, suddenly we've got probably upwards. I'm showing this little volume indicator on my left chart here in the 5-minute chart side panel. That'll jumped over 12,000 in 5 minutes, and which is small compared to the S&P 500 market, but the Nasdaq has a little bit less volume, but it's not really significant enough to change the liquidity all that much. Still, you'll still get your buys and sells very quickly, and 12 to 20,000 is good volume for the Nasdaq in the opening market, and then it'll calm down to about getting the 7,000 range per 5 minutes. But so yeah, it's good high volume, slams right through the support, and so that's a good trade entry signal right there. So that's what I show on the opening here, and so we get our first entry signal at 8321 is the price over here, or the point value, as it slams through the ADMA line, and we see that ADMA opening up from the 14 SMA line. The 14 simple moving average, this magenta line here, is actually the center line for the Bollinger Band indicator, which are these outer envelopes at 2 standard deviation. And so the 14 simple moving average is a 14 period, which I find works well with the ADMA line, exponential moving average, to indicate the crossover changes, both in trend change formations and also within trading ranges. You'll get good trades right at these ADMA crossovers. They work better for trading range type markets. In a strongly trending market, you want to make sure that you're trading in the direction that's shown here on the 5-minute chart, which acts as our intermediate trend line. So you want to trade the minor swings, that are the minor action swings that are occurring in the intermediate trend direction. That's my general rule there. That's how I use the 5-minute chart. Anything I see on the 5-minute chart, I look at this and say, how would I trade the 5-minute chart, and then I compare that to the entry points on the 1-minute chart, and I like to see them lined up. If I see a signal to, let's say, go short on the 5-minute chart, I want to look at what it's doing on the 1-minute chart. And if I see a good entry point on the 1-minute chart, when those two are aligned, that's a good entry signal. So this first entry signal is a break below the support line that I showed in the previous chart, and as the saying goes, old support becomes new resistance. So as we see later in this range, we develop another resistance line here. So that's an old rule that's held true for years, since the markets began. It's a general rule that old support becomes new resistance, and old resistance becomes new support. And we can see that principle happening right here. So what was an old support line for the previous overnight market made a great breakout trade here at the entry. That's the first minute. And so we go short here, and we get our P3 point up here, and then we get our entry back into the market here as the ADMA starts sloping down again. As it starts crossing over, this formation that was a 1, 2, 3 now becomes a 1. The old number 2 point becomes a new number 1, 2. 1 point in the 1, 2, 3 bottom formation here, and that's confirmed at the crossover, so which is another trade signal. On this particular trade here, because of my technique, I risk getting stopped out at the with 1 point profit, and I'll show that technique. But that's a compromise in trying to get out of risk as quickly as possible by moving my stop loss to one point after the entry point is reached. And I'll show that technique in live trading. Then when the other entry point would be here. Another thing I like to watch out for is the Bollinger Bands when they start converging or they're flat. You get into a trade. It's a really good idea to get out at that Bollinger Band line, even if you haven't hit your target yet, and just get out at that, because the likely thing to happen is a bounce back to the ADMA line. So our direction of trade is always outward from the ADMA, close as possible to the ADMA line or on the line, and we want to trade outward towards the outer Bollinger Band lines. We want to try to avoid taking the trade at the Bollinger Band envelope here. Again, the Bollinger Band envelope's set at 2 standard deviations, which I find works well to envelop the range of the market. We can see it's a flat ranging type market here, creating a support line, and usually a range is mature when it has a W or M formation, and so this is a little, maybe one swing past a full M formation, then we get another swing here, or a full W formation. But anytime you get in W or M pattern, we know that the range is mature and it's looking to start a breakout, which it does here. A breakthrough of support. That's a breakthrough of support or resistance is always a good place to use a trailing stop loss type trade. And in this case, it would have worked out just to use a target type trade. And I believe I went short at the next entry point here at 705 with a trailing stop loss type technique. But I use them both interchangeably. I'll use the trade bracket for the 5-point trades, and I'll drop the target and use a trailing stop loss type trade interchangeably. So I always keep that 5-point target in there, but if I decide to drop the target and go to a trailing stop loss trade, I'll make that decision based on how steeply it's trending. If it's flat and sideways, I'll use a target, and I'll also try to get out when it hits the Bollinger Band lines. I'll also use a little bit of a trailing stop loss type technique, even though I'm using targets, to lock in profit in a low volatility type market. But I'm showing the entry points here, 1, 2, 3, 4, 5, 6, 7. So about 7 entry points in about 35 minutes. Each little panel here I'm showing 35 minutes of time from 6:30 opening to the 7:05. And so there you can see the frequency of trading. Each of these would represent about $100 per contract traded. Each point is equal to $20 in the NASDAQ E-mini. So $100, so that's $700 in 30 minutes just using these techniques. This trade right here at 7:43 probably wouldn't have yielded 5 points. But if you're really paying attention and get out at the Bollinger Band, maybe lock in about 4-point profit. I'll see how that goes in the simulation of trading the recording. And just to show you where the price swings are here, I know this chart is really busy, but this is what I'm seeing in my head as the market goes along. I'm paying attention to where these swings form. In another video, I showed how to find these swing points or pivot points by doing the ringing high and low analysis that old traders used to use from the open, high, low, close price data. but you can do it visually just by looking at the charts and seeing where these pivot points are occurring. And it's just second nature to me. After looking at so many charts, you begin just to see these formations in your head. And so we want to trade these according to the swing model here. The entry points would always be, we're always looking for the P3 point, and then we trade 25% into the resuming into the trend direction qualifies the P3 point as valid, and that'll usually occur near the 80 MA line. And so continuing with that, let's see here. What else do I want to say here? Oh, as you can see, the outer Bollinger Bands, they roughly envelop the trading range support and resistance lines. So about where you see these go sideways, these Bollinger Band envelopes, that's about where resistance and support is. So I'm always aware of that as well, because I know a breakout of the support or resistance usually ends up being a really good trade, because as I said, you know, old support becomes new, old resistance becomes new support, and old support becomes new resistance. So it's a good bet that if you break through support, that's now going to act like a resistance line. It's not going to come back above it. It'll probably retest it like it does here, but then it just ends up at the 80 MA line, starts moving sideways till it hits the 80 MA line, then it starts moving down into the downtrend. So that's a good entry point right here. You can see why it's always a good bet to enter as close as possible to that 80 MA line, and you're aware of the slope angle of the trend, as well as the breakout of support. So you've got all these signals going, telling you to that a good trade is happening right here, which is also aligned with the entry point, our P3 qualification entry point here. And it looks complicated right here in these little jagged areas, but if you know how the intermediate price swings are related to the minor price swings, that'll start to make a lot of sense. But that's for another video. I've shown that in other videos, how the minor swings are nested within the intermediate swings. So we'll move on to the next chart. We're ending right here at 705. So this next chart takes up at 705. And we can see it really slams down into a really good downtrend here. And these types of moves, if you can get into them with a trailing stop loss strategy, best of all worlds, because all you're doing is locking in profit. Easiest way to trade in the world. Difficult to get into, but or to know when to trail. But once you're in a trailing stop loss type trade, it's just stress-free trading as you can get. And we get into a little bit of complication here from, see, about 717 onward. It gets into this congestion area, and that gets tricky. But with the right technique, you can endure through some of these. If you make a couple of mistakes, like you might try to go long here at 7:20 in the morning, and you can see quickly you're going to not going to get any movement in the trend direction and get a move against you. But if you're quickly locking in a point, you might get a point out of that trade, and then you do another attempt over here, turns against you, and you get a point out of that, and you can try a short trade here, get a point out of this trade. And as long as you're making a point every time you're attempting to get into a trade, you're not going to go broke. It's just frustrating, but hey, that's $20, every few minutes, basically being wrong. So as long as you're making a profit, you're never going to go broke. And that's trying to trade within congestion, but the best thing to do with congestion areas is just recognize when it's occurring and just try to stay out of it. But since the volatility is fairly good here, you can tell volatility by how close these grid lines are. I've set each one to a fixed 1 point. Now that point ratio is going to vary depending on the type of market you're trading. The S&P 500 is going to have different point ratios, for example, than the NASDAQ. Each point is equal to 0.25 of a point, or there are 4 ticks in a point, so each tick is 0.25, which is equal to $5. So each point is equal to $20, and I've got the grid unit set at $20, or 1 point each for $20. And the way this is by default is it's set to auto scroll, so it'll adjust the point values for you automatically. I didn't like that because I like seeing the fixed points, because it tells me the volatility at a glance. If the volatility is really high, these grid lines will be very close together, so you can see that. You can see volatility at a glance. If you look at the 5-minute chart, the points are much closer together, and they start creating a gray effect on the chart. But at a glance, I can tell the volatility by just looking at how far the point grid units are, or point lines, the horizontal lines. So each of these lines is equal to a point, and you can tell kind of at a glance also if it's going to hit your 5-point target. For example, if you entered here 1, 2, 3, 4, 5, that'll hit your 5-point target pretty easily. So that's a quick way of estimating the profit, just by setting your grid units to fixed at 1 point each. And I thought I guess I didn't put in the I just want to show the entry points, but on this chart I also showed the entry points and the swing lines. You can kind of visualize where those are based on our trade model, and you see right here it gets confusing because it's in a congestion area. And usually, and I'll show this in other video demonstrations, the intermediate points are going to occur within the congestion zones. So this will be a intermediate low at around 7.13, and then you'll come up to an intermediate high around 7.18, and then another intermediate low at around 7 what's that, 726, 727. And so that's actually an intermediate 1, 2, 3, if you're aware of the intermediate price swing structure. And you notice that they occur within that terrible congestion area, which is true of intermediate points for some reason. So the best way to trade the intermediate level swings is to be aware of where it is. That's a 1, 2, 3 on an intermediate level, and just trade the breakout as it resumes into the uptrend direction on the intermediate swing level, which is corresponding with a breakout of the congestion area here. And the other signal is our Bollinger Bands start expanding outward, and our ADMA line is starting to slope upward from the away from the 14 SMA line, concurrent with a breakout of the congestion area. So those are good trade entry points. Again, you've got support and resistance at a more micro level around these congestion areas as well, and you can trade the breakout. You don't want to trade within congestion, but you want to trade the breakouts of these. But I just showed, for an example, trades within the congestion areas. I'm checking the time here because the market for me it opens in an hour, a little over an hour and 20 minutes. So I'm going to try to show this example before the live market opens. And as we continue with the chart here, you can see the volatility gets lesser and lesser as we approach the 9 o'clock hour Pacific time. So 6:30 in the opening is really volatile, but as you head towards 9 o'clock, which is equal to noon Eastern time, a lot of traders are heading out for lunch and at the exchanges, and so you'll hit the normal pattern is for to hit a kind of lull during the afternoon, and then towards the close it gets active again. That's more or less a typical pattern. On strong news days, you'll get volatility through the entire day, but it wasn't any big news happening, so you're getting the normal patterns of volatility starts to die off, and you can see that the market gets a little bit more ragged looking as it as the volatility dies off. And I think low volatility is actually more dangerous, more of a dangerous situation than high volatility, because your targets aren't getting hit. But even as bad as this looks, or as disorganized as this looks, there's still a strong order to this pattern here. Even though it's in a sideways market, we're still getting really good crossover signals at these ADMA lines. You can see how we, as the blue ADMA line crosses over the 14 SMA line, we get these DNA type structures here. Looks like a DNA chain, and you want to trade the side of the market that the blue ADMA line is on. So as this crosses to the upside, we'd want to be a long trader. As it crosses to the downside, we want to be a short trader. And I think you can see those pretty easily where those crossover points occur. And even if we're a little bit sloppy on our entry points into the trade, if you're keeping a 5-point stop loss, those stop losses are never getting hit, but the targets are getting hit if the entry point is correct. And the entry point is correct is when it's on the ADMA line or close to it as possible. And so you really can't go wrong if you're trading in those with those ratios, with 5-point targets, 5-point stop losses, with also your locking in profit as you go. So you're kind of combining all these different strategies to create the highest probability type trades. And you can see where the entry points would occur as predicted. You want to go short as it crosses the ADMA line, crosses over to the downside, and you can see these work out really well when the markets are flat and sideways in this trading range. The crossovers are going to work out a lot better than if it were a steeply trending market. If it's really steeply trending, you don't want to worry about the crossovers, and you just want to trade in the 5-minute trend direction. But since we're in a kind of a consolidation phase here, and we're trading sideways, and we've got the volatility is still good enough to hit a 5-point target each side of the ADMA center line. As you get to the outer Bollinger Band envelopes, we're still hitting 5-point targets there. So yeah, even though this looks random at first, it's still very good trades, very good trading right here, as long as we're trading on the ADMA line. So as you see, as that crosses to the upward side, we're trading in the up direction, even though it's not really trending. But the side the ADMA line is on, the 14 simple moving average, tells you the side of the market you want to trade. So this is telling you everything you need to know. It's telling you to go long here, telling you to go short here, and it's telling you not to trade as it starts to move inward. As we see as we're expanding outward, that's clear signal to take the trade. As it starts to bend inward, don't take the trade until we get the crossover. Then we take the trade as it's expanding outward again. Don't take the short trades as it moves upward, expands inward towards the 14 SMA line. We get the crossover again here, and we take the trade in the long direction. So there's nothing about this that is requires you any guesswork. It's telling you exactly what to do if you know how to read the signals. So there's if you speak the language of the markets, it'll tell you how to trade it, and you just got to listen to what it's doing, and don't try to interject your own opinion. Just trade by a set of rules, and you'll have good success if you do that. If you just keep emotion out of it, keep your own, make it as mechanical as possible, and just let the market tell you what it's doing. As you can see, the swing lines are quite complex. One thing I wanted to notice here is as we're moving in, generally when the Bollinger Bands are constricting or moving inward, you don't want to be a trader, but I did a few trades here just to show how to handle a bad entry. But as you can see, the Bollinger Band line is moving upward, even as this ADMA is crossing over, and it's not really given too many points between the ADMA line and the lower Bollinger Band to hit a 5-point target. So that tells you probably don't want to trade that until it starts expanding outward again, and then it becomes a good trade entry signal right there. But I'll do a couple of these just to show how to handle it if you make a mistake and you enter the trade at the wrong point that doesn't give you enough room to hit your target, and it comes back against me here. Thing you want to do is just recognize what the market's doing and just let it. Don't automatically assume it's reversing on you there. You want to just be patient, and because your stop loss at this point, let's say I'm short right here, 1, 2, 3, 4, 5, my stop loss is way up here. It's not really in danger of getting hit. It'll come close, come within a couple points, but that's what happens when your trades are badly timed. But if your technique is good, you'll get out with maybe a point and then just re-enter it when the market's looking better. So you can't go broke taking a point profit if you're wrong. And so I'll show how to do that. That's just a matter of, even though most of trading is trying to predict the correct trend direction, which this method does. It's all about predicting the correct trend direction, correct timing on the entry, and it does that really well. But the other half of trading is the correct entry points and protecting your profit and mitigating any risk once you're in the trade. And so that's a whole other aspect of protecting yourself and keeping yourself out of risk while in the trade. There's a whole technique to that. And so basically, as we approach the 8:30 hour, 8:30 to 9 o'clock, as it approaches 9 o'clock, it's usually getting less and less tradable, less volatile. In this case, the volatility picked up a little bit, which is unusual, but gave us another couple trades around 8:30, and that's about all I'll really trade is those first 2 hours from 6:30 to 8:30 Pacific time, and that's usually good enough for me. That's when the market's the most active. So I'll show a couple more entries here. In this case, it didn't make a normal 1, 2, 3 point. If we're looking at this would be a hook in the uptrend here, and this will be a break below the number, the P3 point in that hook. And so Joe Ross was a trader who called them reverse Ross hook type trades. I'll just call them reverse hooks. They're not really a 1, 2, 3, but they're enough to signal that a trade at the ADMA crossover is going to be valid, which it is here. It makes a nice nice short trade right there. And as we can see here, it's kind of a lazy, at first it looks like it's going to cross to the upside, and it starts bending slowly downward. And the key here is to have patience. Wait for it to show you what it's doing first. As long as it's angling in towards that 14 SMA line, you don't want to be trading. You can't go long here because it's on the bottom side of the 14 SMA line, and you can't really go short as it's angling in, so you got to wait till it starts to angle outward. Then that gives you a good short signal as it comes back through the 8 EMA line with momentum. And again, here I'm showing the constriction areas of the Bollinger Band with that little red arrow here. And we want to wait till the Bollinger Band starts expanding outward again, which isn't always evident until you're into the trade, but you're kind of anticipating it. Okay, and I know I've been talking a lot here, but let me just try to get into actually trading this market. I think I'm going to make another long, boring video here, starting so late. Let's just get it started here. I'm hitting the market replay program. As you can see, the volatility is pretty active, you know, when the first trades of the morning. And so remember, I can set what I can do is set a stop loss there. I mean a sell stop. It would have hit my target normally. I just got out of that because I want to do a trailing stop loss type trade. So this is how quickly you can start locking in profit here. Might as well lock in a good, let's just lock in a point at first until we get a close in the first minute. That'll give us a handle on where to trail the next stop loss, but initially you either want to give yourself a tick for the break-even point. That'll cover the broker's commissions, or at least a point. And we got enough distance here where we can lock in a point safely. In fact, accidentally hit the wrong side of that. I'm trying to hit that little up and down arrow to move the stop loss. Don't want to move it too close because now it's coming up against me here. Let's see, I'm in a risk-free trade at this point because I've got 3 points locked in. And all I'm doing here, as I showed on the chart, is I'm trading the break below support. And so we got 45 seconds into this minute bar, and normally I'd want to use this timer up here, but it's not accurate in the market replay program. Normally you'd use a countdown timer here. So now we get the new bar so we can move our stop loss down and lock in a little bit more profit here. So we're at already within 3 minutes of the market open. We're trading one contract, which anybody can afford to do with $500, and we're already at 200, fluctuating between $200 and $300 there profit. Now it's going to be more accurate in the real market, because in live trading they'll deduct your broker's commissions, which are going to be about $3 or around $2.80 per round term commission. A little bit more expensive with this broker, but they're also providing all the software as well, so it's a pretty good deal. You know, if you're paying around $2 or $3 for commissions, that's not going to make or break you if your trading's any good at all. It's kind of negligible. So I always keep my finger on the exit button in case it doesn't get me out. keep my cursor on the exit. See the exit market feature here automatically executes the orders in case these aren't executed. So just as a backup, I keep my cursor on these exit or reverse, or usually the exit and reverse are the main ones I'm using here. I try to use the reverse and cancel very sparingly. So what we're looking for here is another P3 point, and because we've got a break above this point here, and this is a fairly long move down, I'm not in a rush to assume a P3 point. Excuse me. Like Hillary Clinton there. Wow. Yeah, I can relate with Hillary Clinton. Getting something in your throat. I was just going to say, wait for that number P3 point to form first, and don't get in a hurry to take the trade unless you've got positive momentum. See how I want to see this this closing tick fall below this opening tick here on this current price bar. And I'm also watching the 5-minute chart. See how we're trading below the Bollinger Band on the 5-minute side. And the tendency right now is it wants to come up towards the ADMA line on the 5-minute chart as it comes back up here. So I'm not in a hurry to trade that unless I see momentum. I want to see that P3 first, and then I want to see momentum backing down into the short direction, because this could also be this is also what it looks like a lot of times prior to a reversal, and you're seeing the ADMA line bend upward. I don't want to see it bend towards the 14 SMA line. I don't know what it is about this year. I've had chronic allergies for some reason. They're getting worse every year here in Sacramento. Usually a really strong sign of reversal is if you reach that magenta colored 14 SMA line. That's a good sign that it could be reversing on you there. So we haven't had a 1, 2, 3 bottom formation, so I'm not in a hurry to go long until I get a number 3 leg here. But I can't go short either until I get this ADMA line crossing back, sloping down back down in the direction of the trade. So knowing when to trade is important as or when not to trade is important as knowing when to trade. And so that keeps you out of trouble, just watching all these signals. See, as I get this, I'm pretty sure that that's a solid P3 point. We've had so much movement in the down direction now. Now we're crossing back below the ADMA line. So I'm going to get short at the next, if that maintains that momentum going downward, I'm going to get as short as close as possible to where I think that ADMA line will be, right about there. Okay. Even though it's not really sloping down or sloping downward yet, so that could be a That would probably have been a better point to go short as it broke out below the low here. And as this bar, the entry bar, as it hits a point of profit in the profit zone, I'll start trying to lock in a little bit of profit. You can always tell the character of it. It's not really too sure, but it is creeping downward into the profit zone. I just want to wait for it to close first, and then I'll move my well, it's moved such a significant amount down. I'll just move to lock in profit there. So even if it gets me out at that, I've locked in a tick of 0.25 of a point. 25% of a point is a tick, and that tick is 5 points. That'll at least cover broker's commissions if it comes against me there. Almost took me out of that tick. So either give me a tick of profit out, or hit my 5-point target, whichever comes first. Either way, it's a little bit of profit to cover broker's commissions, or it'll hit my profit target. So either way, my odds at this point are very good of making some profit out of this trade, just by the management technique. The reason I was so quick to lock in the profit there is because I was unsure. We're not really getting a good slope down, and this is putting in what looks like a trend change formation, or 1, 2, 3 bottom. So those signals tell me that it's getting ripe for going long, or making a intermediate 1, 2, 3 bottom. So we'll just no reason in spending so much time. Where I can, I'll speed it up to just save some time here. See what I'm seeing here. My suspicion is this: it just looks like a 1, 2, 3 bottom. We've got the ADMA line sloping inward, and look what we're confirming on the 5-minute chart. It's coming back up through the. Remember, the tendency is on the retracement swings, it'll come back up from the outer Bollinger Band, especially if it has a close outside the Bollinger Band line. The tendency is it wants to come back through the Bollinger Band to hit the ADMA line. So you always want to trade outward from the ADMA to the Bollinger Band. I'm looking at the 5-minute chart here, and we can see it's in an up move, or retracement swing, from the outer Bollinger Band, the lower Bollinger Band, to the ADMA line. And that's being confirmed by what we're seeing on the 1-minute chart. So you got those two signals in agreement that we're in a upward move here. We're about to cross over at the ADMA. So all those signals tell me, okay, you don't want to go short right now. We're about to cross over in an upside trade here. So that's what I'm going to look for at our next entry, as a crossover of the ADMA line. I'll just slow it down to the regular speed here. You can see how just by understanding the signals, there's no guesswork involved. It's telling you exactly what to do, how to trade it. It's telling you exactly what it's doing. It's really not trying to. Some days it'll try to fool you a little bit. It does play tricks, but if you really understand its language, it's not really trying to fool anybody. It's telling you exactly what it's doing. So now an entry here is a bit of a gamble, because look how this kind of this upper Bollinger Band is acting as a limit on the target. So I might not hit my 5-point target there. So I'm just, okay, hit my 5-point target. But you see how that works. That upper Bollinger Band is really contracting inward along with the lower one, and that's kind of showing you where the limit is of how far you can expect a move there. You want to see the Bollinger Band start to expand out if they're going to start a new trend. So what I'm looking for here is first of all, I'm looking for since this is an assumed 1, 2, 3 point, looks like an intermediate 1, 2, 3 is very large. I'm assuming that's a P3 point in the new trend direction here, even though it's flat. So we're kind of moving sideways. So I'm not expecting this trend to be all that great yet until it really starts moving upward and breaks above this number 2 point here. See how we're forming a resistance area of highs right there. So that's about what I'm expecting for my targets. This could be a situation where I'm not going to get a regular P3 point. So I'm trying to get in at that entry point. I'm not expecting much out of this trade right here, so I'll be quick to get out if I get any profit at all. So I'm going to get my cursor on the exit at the market button. Feel confident it's going to go in the right direction because I'm at the 80 MA line that's expanding outward, and I'm right in the new trend direction, which is usually going to be a good trade. But we're kind of capped by the resistance area here. So matter of fact, I'll just go ahead and lock in a little bit of a profit. If we do take a loss, it's not going to be much. It's going to be 20 bucks or something. If I don't think it's going to get hit, I'll just lock in the profit there. And as soon as it hits that upper Bollinger Band resistance, I'm just going to get out. There we go. See why I did that? I'll show the line here. See that I don't even need to use that cursor. Right there is I'm seeing resistance, and what usually happens at resistance is gonna, if we're in a trading range, it's gonna bounce back downward when it hits that resistance. And this resistance is where we got short before. So what was old support becomes new resistance. And I'll just show that here. See what we're looking at here, that was the initial short entry point. And what I'm already seeing at this point here, I'm already seeing a resistance form, because this was the old support area and this is the new old support becomes new resistance. So we can expect the moves to come up to this old support line and then bounce back down, and that's exactly what we see happening. It's very common. This has been going on for hundreds of years, just the way the markets tend to move, and it's just a universal rule. Resistance and support, you could just make a living just trading the breakouts of resistance and support and the bounces between the two, as long as the volatility is high volatility is high enough in the range between the resistance and support areas. And just by knowing where these are, you can make a really good living, just knowing nothing more than that. And so that's where we are right there. I'll continue. Usually a good rule of thumb, if you're in a trading range, try to only take one trade each side of the range. It'll hit one side of the range, then come back down. Usually cross over the ADMA line and hit the lower Bollinger Band. So the Bollinger Bands are good envelopes or containers of the range, as well as support and resistance areas. So you're kind of watching both. When those Bollinger Bands start to move sideways and they start to contain the range of the market, you'll get a good feel for support and resistance areas around where the upper Bollinger Band is and the lower Bollinger Band is. So I'm not really interested in another trade unless I see a break above resistance here. But I know this is a young range until it makes a M, like a capital letter M or a W formation. And then usually when it reaches those formations, it's a mature range. That's a general rule of thumb. It varies. There's no set absolute rule, but those are good guidelines to know when a range is mature or not. Okay, so we have the ADMA line bending inward. We don't have a 1, 2, 3 top formation, which you will get in ranges. You'll get the 1, 2, 3 top, 1, 2, 3 bottoms. But if that starts really converging on that 14 SMA line, it's a good assumption that it's going to cross over to the bottom band, even if my timing's a little bit wrong. So it's a pretty good bet that we're trading a bounce off this resistance area here. We got a lot of good signals showing that, plus we got the crossover line, so you're probably in a good high odds trade if you take a short trade right there. See how the ADMA line is bending inward? You want to look at these like sine wave cycles, and we're in the downward cycle in a range. And so if that crossover occurs, we want to probably be a seller. And we've got this distance, gives us good gauge if we're going to hit the 5-point target or not. We got at least 5 points between the ADMA line and the lower Bollinger Band. So it's probably a good bet to go short there. Just wait for the crossover to occur first. It's hard to have patience on these things because I see it sitting right there on the 14 SMA line. But yeah, it looks like it pretty much crossed over right there. Let's wait for momentum. So wait for the momentum into the direction of the trade, and then always wait for momentum or to come back down in the direction or back up if you're long. So at this point, I'll just go ahead and start locking in. Oh, I'm not locking in profit. I just avoided the 5-point risk right there. So I'm taking about a $20 risk right here per contract. This is always the kind of tense area of trading right after entry. Makes you sweat a little bit. If your entry's good, though, it'll usually move on fairly rapidly into your intended direction. So now I'm out of the risk completely. And so basically, one of two possibilities here. It's either going to hit my target, which it just did, or get me out of the trade at a small profit. As long as I'm covering commissions, I'm not losing any money. So you always want to make sure you have at least a tick of profit locked in. That'll cover the broker commissions. So we've got a kind of an M formation right now. So if we're looking at the 5-minute chart, we're really, this is why I use the 5-minute chart, because we're seeing something here that's not as visible on the 1-minute chart. We're seeing it's really good, strong, if that box will get out of my way, seeing a strong downtrend as indicated by the 80 MA line expanding outward from the 14 SMA line on the 5-minute chart. And that's just made a 1, 2, 3 on the top side, 1, 2, 3 top. So we're anticipating a continuation of the 5-minute downtrend, which means a breakout of the support on the 1-minute chart here, if you see how that works. So what I would like to see here is it move up, and it makes a 1, 2, 3 pattern before it moves back down to try to break through support, if it's going to continue that direction. And if we look at the 5-minute bars, look how the closes are below the opens here. And I'll just speed that up and see what we have. See how it's trying to move upward, but as long as this 80 MA line is on the bottom side of that magenta colored 14 simple moving average line, you can't go long. You always want to trade the side of the market that line's on. Even if we did get price bars that moved up in the upward direction, that generally keeps us trading the right side of the market there. So you didn't really get a crossover there, and I'm anticipating a 1, 2, 3 before a breakout of that support area anyway, and we don't want to be trading against that larger intermediate trend as it's close to the, see how it's close to the 80 MA line on the 5-minute chart? It's just the same rationale as I would use on the 1-minute chart. When we're making a P3 point on the 5-minute chart, which would be the equivalent of a intermediate I3 point, the minor points for the pivot points I'll call P3. I just use the term point based on what Charles Lindsay's work. And for the intermediate points, I'll just call I1, I2, I3. So as we can see, it's making an I3 point here about 83.16 or 83.17. And as that starts to come back down through that previous open in the direction, what I'm expecting is a bounce off this. I guess that's what I'm trying to say here, is I'm expecting a bounce off this 80 MA line on the 5-minute chart. If you see what I'm saying, that's equivalent of around where the upper Bollinger Band line is, right here at that 80 MA line. The upper Bollinger Band's a little bit higher here, but I'm expecting a bounce back down into the 5-minute trend direction, because that's still fairly steep, if you can see that. It could also be forming a 1, 2, 3 bottom, but I would need to see it curve upward towards the 5-minute SMA line. Though we're seeing a really strong outward movement here, and it's probably just going to bounce down. That's how I'm using that 5-minute chart to kind of gauge what I'm going to do on the 1-minute chart, which is a break below support. So I'm getting ready to sell as this starts moving downward, and I assume this is a 1, 2, 3 pattern here. I'm getting ready to sell on that 1-minute chart. I think I just missed a sell point. Oh well. What I'm looking for here, you generally don't want to buy or sell near the Bollinger Band. Ideally, I probably should have sold right there at the 1-minute ADMA line. But since I'm anticipating a breakout, I might decide to get in this trade a little bit later. Only reason I missed that is because I just sped it up at the wrong time. But yeah, just see if that works. So that timing's a little bit off. I'm about 2 points beyond where I wanted to sell. I wanted to sell right at that open here in this 1-minute bar. I could have sold right there. I should have just had some patience. So that's where you can get into timing problems. And so if I'm wrong there, I'll just let my my stop loss get hit and re-enter the trade when I can. See, it's going to do one of two things when it hits support like that. It just hits support. It's either going to break through it or it's going to bounce off it and back upward. And I could take out a little risk out of that trade. Matter of fact, I'll take a lot of risk out of the trade. I'll just move it to protect my profit there, or my position. See how I start feeling comfortable as it gets 3 points towards the target. Just hit the target, and we're getting the anticipated breakout. And the real live trading, because I wasn't messing around with the market replay, I got right at the ADMA line in anticipation of a breakout, because I knew see how the ranges mature here. We've got our W formation, we've got an M formation and a W formation, so it's more than ripe for a breakout. So we got that trade hit. We're just looking for the next. What was support here will now become the new resistance, or another way of saying that is the old floor becomes the new ceiling. So I'm waiting for it to come back up to the right around where this ADMA line will be. Look for a new P3 point and a new trade to the downside as it bounces off this new ceiling here. I'm just going to speed it up until we get the new P3 point. See how in this situation, if I went short here and I anticipating a breakout of that support and I just dropped the target, it would have been a much more profitable trade, not having artificially limited myself to 5 points. I could have traded at the Bollinger Band line as it comes back up through it, and that would have given me a little bit more than 5 points. But you know, if you're making $100 trade, it's in a few minutes. Nothing to complain about there. See, we got a Phantom P3 point. That's a P2 point right there. You have a low that's lower than the previous low and lower than the low that follows. That creates a P2 point. But you can see we have no corresponding high here. So in that case, you take the high that's the highest bar between that occurs after the P2 point. And so that would be a Phantom P3 point. On these, I usually like to trade the opening bar. But the trend really isn't really strong yet. It's not a very strong trend. And we've got a long move upward against it. So that's a little bit too far away from the ADMA line for my comfort area there. See, there's a more legitimate P3 point, whereas this was a Phantom. You could have got short right about there, but it wouldn't have hit the target, and you'd have to wait through all this reverse movement against you here. So since that's a P3, probably a P3 point, I don't know that yet until we get movement down back into the trend direction, and it starts bending this ADMA back down. Then that'll confirm an entry, and I'll try to enter wherever this close is, as long as it's close to the ADMA line, and the new open should roughly be where that old close is. So getting ready to sell. You can place a sell stop or sell at the market. I don't think I'm going to get much move against me there, so I didn't want to wait for it to move too far away from the ADMA line. So sometimes you don't get the luxury of having it come back down with momentum, and you got to be ready for that. The hardest entry is the same bar entry, the same bar that makes the P3 point. Because we've got a breakout of resistance here, I'm going to show you a trailing stop loss trade. So I just dropped the target, the artificial 5-point target, and we've got so far $780 in profit. So I'm just going to risk that profit and start doing some trailing stop loss type trades. Even if we get stopped out at a small loss here, a lot of times it's good to also trail on the 5-minute chart. So if we're looking at a 5-minute support area, see this upper line here about, it was at 8306 or 8307. Right about there is where my stop loss is placed, above the previous high of the previous 5-minute bar. You can't see it really, but if you had this trade mode open on the 5-minute chart, you would see that it's the stop loss is right above the previous high. We've moved so far in the profit zone now, there's no reason to stay at any risk. So I'll move into the profit, start locking in some profit here. And so that's basically how you trail a stop loss, trail a trade. Once you're in this situation, you're really in a no-risk trade. And so it's the most relaxing way of trading, because you're no longer technically in risk. Sure, an anomaly could happen where it just takes out your stop loss and you get some slippage, but we're in such a strong downtrend here, that's not likely to happen. So when we get the new bar, I'm just going to move to the high of the previous bar. Like I said, I could trail on the 5-minute chart, but most of the time the trailing on the 1-minute chart works out. 5-minute chart will make it a little bit smoother, so you don't have to re-enter a trade. Or you can trail the ADMA line, where the current ADMA line is. That's a good area. Usually I'll just go above the high of the previous price bar. See how we've got an inside. If we weren't already in a short position right here, you could re-enter it here, because in a steep trend, this would be a phantom P3 right here, or what I call an inside bar. And you can see you get the number 2 point here, but you don't get a proper P3 point here. So you could go short at the previous close if you weren't already in a short trade, which I am right now. So since we're just trailing, so 30 minutes into this day, we're already in over $1,000 profit just for using these simple methods. And this is, like I said, this is per contract, one contract trading. You could, if you look at the quantity indicator window, you could trade up to I don't know, it depends on the size of your trading account. You know, I could trade 40 contracts at a time, so you get 40 times, that'd be $40,000 right there. But we're not that rich, so I'm just doing one contract trading examples. But it's the same ratio no matter how many contracts you had, so you can see how the power of leveraging. This is why futures trading is so lucrative over stock trading, especially the E-minis futures, because your day margin is so low. The profit to risk ratio, I mean the leveraging ratio of $500 controlling whatever the index value is times $20 per point. So, you know, 84 times $20, and that gives you some idea of the value of the contract. Because it's $20 per point. So for $500 margin, we're controlling that huge value of a contract. So that's same principle in real estate. Only in real estate, there's usually about 1 to 10 leveraging. In commodities, it's about 1 to 100, especially when you're trading the stock index futures. But that's a double-edged sword. If you don't have a good method, that kind of leveraging can work against you, which is why futures trading has always been considered kind of dangerous. But if you have a good method, like I'm showing you here, that it's much less dangerous than it needs to be, because the market really does tell you what it's doing. Like right here, it's closed outside that Bollinger Band. It tried to come against me a little bit, and so I'm getting really cautious about the trade trying to stop me out here. So right here, it's trying to decide whether to continue in the trend, and so it's forming a little ledge here. So if you're not short already, this is another good point. You can see how these steep trends, when it starts becoming a steep trend, it doesn't give you a lot of opportunities to get in, which is very difficult if you're not already in it. Once you're already in it, you don't want to get stopped out. Then you have to you face the problem of having to re-enter something it's more difficult to enter a trend once it's already started. And so you try not to get stopped out too quickly here. But I see what it's doing. It's forming a ledge. A good way to enter these a lot of times, if you don't get a P3 point, is to trade the breakout of the ledge, the support area. So you've got support occurring at the macro level and on the micro level. And so we hit these little support areas I call ledges. So if you weren't short already, that'd be a good area to get short right there. I'll just lock in that profit. So I know where it's starting to, where it consolidates. You know, it starts moving sideways like those little areas. You get really cautious to try and not be stopped out if you're already in a good trade. Or you use these little consolidation zones as areas to enter a trade, especially when it's in a strong trend like this. This is what I would consider the definition of a steep trend. It's about 45 degrees. And we can see the ADMA is continually expanding outward from the 14 SMA line. That's a good healthy trend right there. And you know, it might only do this for a few minutes a day. You might only have these for maybe half an hour, then the rest of the day could go sideways. But when they do occur and you're in them on a trailing stop loss, it's the best of all worlds. I'm going to have to, if you see the time down here, this is the actual time. It's 6:07 in the morning, and the market started at 6:30, so I'm going to have to stop my demo video, even though I could do this for the couple hours of trading. And I'll probably continue maybe in another video, but because there's some important areas I want to show about what to do if you screw up a entry trade, or you enter in a bad area, or trading in a congestion area. And I wanted to show a little bit about that, how to handle those situations. But right here, it's kind of a no-brainer. You know, you're just moving the stop loss down to lock in profit behind the previous bar. If this were an uptrend, it would be the low of the previous price bar, but since we're in a downtrend, it's be above the high of the previous price bar. And I'll just trade until it stops me out here, and then probably end the video. It's probably gotten too long already, but yeah, you get the idea of it. Okay, so that's about 45 minutes of trading, and profit is $1,180 per contract traded, just using a few basic simple techniques. And there's no speculation here. There's no I know they call trading speculation, but there's really no guesswork or speculation. We're just following systematic rules. And if it's mechanical like that, you get into another level where there's no the emotion gets taken out of it. There's no reason to be doubtful, because you're just following a system that has your odds in your favor built into the system. If you deviate from that system, you can start to become a gambler. So as long as you've got good discipline and sticking to the system, it's going to work out, because it's designed to, work a certain way over the observation of many markets over 20 years of trading and looking at markets and looking at characteristics. I've kind of distilled it down to a few things that work consistently, and as long as I stick to those few basic rules, the odds are on my side. if I deviate from those and I start becoming a gambler, trading can be gambling just as easily. And so you want to avoid that, and just stick to a good method, a good discipline, and these kind of things are possible to every day. You can. Right now, the volatility has gotten a little bit better, so the market's a little bit more lucrative. There was a day this week that wasn't so great, but yeah, when it's about this level of volatility, you're going to have these opportunities all the time, and it is more often than not. You'll go through months where it's kind of low volatility and not really great, but you can still eke out a really good living out of those as well. Even if you're down to $500 a day per contract, you're doing really well. Even $200 a day per contract, and that would still be doing very well. Because all you have to do if you're getting really low volatility like that is just increase your contract level. So I'll just end it here, and I'll see you in the next video there.